Welcome to the Brew, the Trader's Workshop. Today we're tackling the third Greek, Theta. So we're going to just get right to it and talk about Theta. This is a good melting ice cube story. So let's get on to the opening bell.
Wow.
We'll cut that music down a little bit shorter in the future.
Wow.
Max likes to play it longer. I think we need 2 or 3 seconds of that. Yeah, I like when you come off the cold and then you go into seeing you guys. We need a little fade in and fade out of music, right?
And there's nothing that doesn't work with an air guitar.
That's right. Pretty soon we're going to be all doing air guitars. I know. All right. So,
Lex, you make up your own grammar as you go along.
I do. All right, boys. We are doing a series. This is the third in a 5-ish part series. It's probably going to be more than 5, but I'm making that up. On the Greeks. So we've covered delta and gamma. And in my mind, next would be theta. So I always refer to it as delta, gamma, theta, vega, rho. Some people may think of it differently, but anyway, we're at theta.
There's some sort of like Roy G. Biv thing that you can make out of that. Like, my very educated mother just served us 9 prunes or something, you know.
Yeah, we'll figure that out too. But do you guys think this is an important one or not an important one? Theta. We're going to define it and all that stuff in a second. But, you know, little jibber jabber about theta. What do you think? Important, not so important?
Everything,
vital, not so vital?
It's vital if you have to pay attention to it. Although I think delta and gamma and vega even are more interactive and more important to form a thesis around. Because, I know you didn't ask this, but the definition of theta is...
Wait, hold on a second.
Oh, okay. Sorry.
Should I go to the slides?
Oh, yes. Lex prepared.
So
okay.
I guess I asked the question, how important is theta to a trader? Now, there's 2 kinds of traders. There's the retail. Well, there's more than 2 kinds. There's retail and pro, let's say. Pro encompasses a lot of things, institutional, hedge funds, all that stuff. And then retail is what, I've morphed to, and I think you guys have morphed to. Boy, people are disappearing left and right here. Where did Mark go?
This is recording. Should we restart?
I don't know. I lost Mark. Mark went bye-bye. Where'd he go?
Yeah, he froze.
Mark's back. He's back. He just stated and he came back. He decayed to nothing and he came back.
And I enter with an air guitar.
All right. Are you okay?
I think so. I think I am.
All right. Yeah. So anyway, theta. My question was, look at him with that.
That was a great freeze frame.
How important is theta to, let's say, a retail trader? First, I think we're going to wash the pros out for a second. Okay, you were saying, Jason, theta, importance, yes or no?
It's something that absolutely has to be paid attention to. I do believe that delta and gamma are 2 Greeks that should be paid attention to more. And I think vega, which we'll get to next time, is kind of more impactful onto your option position. But theta is definitely something to look at. And it's something to keep in mind, especially the retail trader is typically long gamma. They're buyers, net buyers of options.
Okay.
So theta kind of gives them that ticking clock. It's like that ticking time bomb kind of thing.
Okay.
So they have to make sure. Yeah.
Okay. Good. Mark, without defining theta, because that's in our slides, importance of theta to you and the retail trader and or whoever you want to talk about in terms of theta?
Yeah, I think I totally agree with Jason. I think theta is very important, like no matter who you are as a market participant, right? Like I think market makers might think of it more as like their ongoing bill to maintain that position, or maybe even a little bit how they collect it. But I think what's most important about theta is that it often gets misrepresented, or strategies often get designed around like theta collection or something like that. And I think that's usually harvesting theta. Ding. But ultimately, those types of trades, if you're selling cash puts, you're not selling, you're long deltas, right? Like delta is the trade there. If you're selling condors, theta's not the trade, vega's the trade, realized volatility is the trade. So like I think theta is super important, but often gets sort of focused on or mischaracterized.
Right. Okay, fair enough. Okay, let's do this. Let's go to the slides. Right. Okay, can you guys see this?
Yes.
How wonderful is that? All right. So theta. Mark, do you like my Dolly picture? That's it in the corner. That's the Wicked Witch melting.
It's only trumped by the amazing graphics that are in the upper left.
Yeah, that's not so amazing. I took that off YouTube. I didn't have that slide in the folder, so it's a little fuzzy, and I had to cover Jason's shoulder because there's a timer there too. Nevertheless, we're going to get onto it. All right, who wants to define theta? Here's what I got: the theoretical rate of change of the price of an option due to the passage of time, typically a one-day period. Okay, I know there's more to this. Let's unpack it. And what can we add, Mark, Jason, to this or take away? What are we thinking?
Okay, so first off, I do love this graphic. Genuinely, this is some expert dollying. I'd love to see what your prompt was for this because, yeah, that's great. Graphics, A+. Definition, I think, pretty good. I mean, how much is your position going to change just because of the passage of time?
That's right. Now, Jason, would you say that it's typically a one-day period that we look at, but there's hour periods, and I know people talk about weeks and months. Important or not important, or do we just stick with the traditional definition of a one-day period? What do you think? Or either one of you guys, sorry.
One day is a good thing. It's an easy change in the calculation if you want to change it from 1 day to 1 hour. But the thing you have to keep in mind is if you're using a 1 day time period on theta, and you're trading 0 DTE, the numbers are going to look astronomical, and it's not necessarily what you're getting. Especially, in like that last hour, no matter what time frame your theta is in, it always kind of exponentially decreases the time until expiration until that last minute, and it goes kind of asymptomatic to infinity. So, basically, when you want to see theta, though, if you're like a swing trader, you're trading on like a 2 day or 2 week or 3 week time frame, that's fine, or greater. But if you're trading like 0 to 2, 3 DTE, you might want to be careful. The other thing to note is it's the passage of time, calendar time, right?
Yeah, I was going to make that point. I was going to ask about that. So we have Saturday and Sunday built into this too. So how does that play out? Because those are non-trading days.
So, I mean, when you're looking at the static view of theta, it plays out normally. Like it plays out as if you're going to make 3 days worth of 3 days worth of theta for just one market day.
Right.
In reality, that's not the case. You kind of notice sometimes on Fridays on the VIX, or really on any implied volatility, you'll see it kind of under VIXes a little bit. Like the implied volatility comes down, anticipating the fact that Saturday and Sunday are not going to be market days.
Yeah. So let me ask Mark this. Mark, you still here? I can't see you. Is Mark here?
Yep.
Oh,
yes,
sorry.
Yes.
Hi, Mark. So how did we deal with this in the trading days on the floor? So what I mean by that is Jason makes a good point about the weekends, right? So you can either liken the 2 days of the weekend to lowering implied volatility, which may have the same effect as thinking about moving your data ahead when you compute what the value of an option is, right? They're very similar in a way, I think. Any thoughts on that, Mark?
Totally. I think, messing with the calendar is definitely something people do intraday, compared to the intraday session versus the overnight, as well as the weekend, where it's obviously more drawn out there. And sort of like you say, one of the ways that, when you start manually fudging it, just like you sort of start manually raising your puts because you don't know that skew exists, but you just got to raise those. Like you start fudging the days ahead because you realize that calendar time on the Saturday and Sunday aren't the same calendar time that are passing day over day. And so you would fudge your days ahead rather than lowering the volatility. Because if you lower the volatility, you come in Monday and the time has passed, and all of a sudden now your vols are low when what wasn't happening was a vol phenomenon. It was a calendar time phenomenon.
Right. And I wanted to make that point. Jason, you might not agree with that, but here's
No, I agree with it.
Okay. So what people should be aware of, especially the retail folks, is, and be careful of, is when they see those options getting cheaper on a Friday, especially because we have Saturday, Sunday, right? Don't think that volatility is coming down, okay? Because it could be, it definitely could be, but traders, market makers, the whole system is taking time out of it because you have Friday, Saturday, Sunday coming. So it's not necessarily an implied volatility change. It can be, but it's not necessarily one. It's probably more of time being whittled out for Saturday and Sunday. And I'm guessing, Mark, these pro shops, the Susquehannas of the world, probably have a pretty fancy model that accelerates the weekend somehow during the Friday session. Is that fairly accurate, do you think?
Yeah, I'm sure a lot of this is automated now, and the time expands and contracts based on the volatility environment. Like you can think of some second and third order variables to, if you really want to tweak it.
Right.
But back in the day, we would definitely adjust it based on almost the feel, right? Like a busy Friday isn't going to decay as fast as like a slow Friday.
That's
so
right.
Like your judgment on like when to run those days ahead was again one of those sort of like things you're like, I don't know exactly what this phenomenon is, but I know nothing's trading, so I should probably go days ahead faster rather than we're up 2%, like you're not moving your days ahead until the end of the clock.
Okay. So we like to call theta time decay, at least we in the pro world. Jason, do you call it time decay at all?
No, I mean, I always call it theta, but I mean, it's time decay, same thing.
Okay. Now, I don't know why that funny blue line that goes up is there. That's just a mistake. But the red line is the at the money line. The blue line is the in the money line. So this slide, think of theta as time decay. So theta affects time value or extrinsic premium. We're going to define that in a sec. Okay. It does not affect intrinsic value. Okay. And theta is not linear, but accelerates near expiration. That's what the red graph shows. So if you look at the time to expiration, you can see that curve sloping down, going out in time. So you can, I'm sorry, the other way around. So you can see it, theta really accelerating as we get to zero time, right? And who wants to take that one and kind of explique? Feel free, jump in. Don't be bashful.
Go for it, Jason.
There are so many lines on here. I'm trying to still figure it out.
The red line, just think about the red line and forget the top blue line. That one's a silly one. I don't even know why it's there. I don't remember putting it there. Don't worry. In editing, I'll take that out. So the red line is the at the money line. That's a typical theta graph. I had to draw it with my hand, so it might not be as steep or curvaceous as it should be. But anyway, go ahead. Sorry.
Yeah. So, I mean, when you're thinking of time decay, you have a static time until expiration. And the only thing that's actually moving is your current time. So it's just kind of getting closer and closer to that time of expiration. It is an exponential, I always call it an exponential constant because it's moving at the same pace and the finish line is not moving. Mm-hmm. So as you get closer to that time, as you get closer to expiration, theta increases at an exponential rate. So, I mean, if you're 30 days out, kind of as that red line indicates, it gets more and more, the decay becomes greater and greater as time draws near, as the expiration draws near.
Yep. So to add to that, for the folks, just think of this, that when expiration happens, okay, an option has to be worthless or in the money by its parity number. We're going to define these terms in a sec, okay? So that extra value above and beyond parity has to go to zero. And if it's in the money option, it's going to go to the parity number. If it's an out of the money option, it goes flatly to zero, right? So that number has to decay to that. Extrinsic value. Do you guys refer to it as that, or what do you guys call it? Time value premium? Mark, any ideas on that one?
Yeah, I'll say one more thing about the theta decay, though, is I'll paraphrase Hemingway perhaps here, in that theta decay is like bankruptcy, in that it happens slowly and then suddenly.
Right.
And so that flat part of the curve is You kind of grind along day by day, and then all of a sudden it drops out. Like
Right.
that extrinsic goes to zero, because as long as there's time on the clock, something can happen.
That's
so,
right.
It really has to, it craters off the end.
Right.
So
Okay.
yeah, extrinsic value is interesting, and like the parity comment is interesting too, because like if theta is the daily decay, you can kind of think of your extrinsic over parity as the gross amount of theta that will ever decay in this, option.
That's right.
How much out of the moneyness is there that will go to zero if expiration clock hit today?
That's right. Okay.
Yeah. The one thing that I will say though about extrinsic value is, the theta is, yes, it's a big part of extrinsic value, but the vega is also assigned a portion of that extrinsic value, and it says their time value premium.
Yep. We'll talk about that too in a second, but yeah, you're right about that.
Okay, then never mind.
Yep. No, that's good. That's a good point. Okay,
Yeah.
so extrinsic value is the time value premium. It's the amount above parity. Okay, and we'll show calls and puts in a second. And then intrinsic value is that amount of parity in the money option. So to be clear for folks, an out of the money option does not have intrinsic value. There is no parity because it is in essence out of the money. It is all extrinsic value or time value premium. Okay. All right. Call and put extrinsic and intrinsic values. For calls, extrinsic value, that's the time value, that's the juice, that's the fluff, that's the premium. Mark, you may look at this differently, but let's just see if it works. Option price minus the quantity, stock price minus strike for a call. Help me. Does that sound right?
I agree with that. I'm sorry, I'm nodding. I'm distracted by this picture because I think like a great caption. He looks like Neil Kashkari. And he looks like Neil Kashkari looking at the market overpricing future Fed rate cuts. I
love it. That's so good. Too much value.
The disdain he has for these bulls is palpable.
I love it. Oh my God. All right, Jason, we're good on extrinsic value?
Yep.
So think about it. An option price that is, I'm just going to make these numbers up, $10. Okay. Yeah. And then the stock price minus the strike price comes to be $7. Okay. And I'm just making these numbers up. So in this equation, 10 minus the net 7 is $3. That's the extrinsic value, the amount over parity. And parity for a call is defined as that stock price minus the strike price for in the money options. Right? Mm-hmm. So think of it. If it's in the money, the strike is going to be lower than the stock price. So you take where the stock is, subtract that strike, that difference is parity. Anything above that is extrinsic value or premium or, time value, whatever we're going to call it. Yeah. Anything to add, guys?
Basically, if you exercise that option immediately right now, how much money are you getting? That's the that's the intrinsic value.
But here's also, that's a good point. I forgot to add that. But here's an important factor. If you exercise an option that has $3 of extrinsic value and you exercise it before expiration, okay, what happens? You lose the $3, right? That goes away because you're exercising down to strike, right? That's what you're doing. So you're getting the strike. So whatever the price of that option, you're getting the difference between the stock price and the strike for a call. And all that fluff goes away if you exercise early and there's time value premium left in that option. So beware. That is something you probably don't want to do unless there's a dividend involved, but that's another story. We'll talk about that later. Any comments, Mark, on that one?
You stole my thunder. I was exactly going to say the early exercise for dividend, which is why you look at that extrinsic value and say, does as the sort of barometer for whether it makes sense to punch for interest rate or dividend reasons.
Right. Okay, good.
What I'm giving away, is that better or worse than the interest I'm saving or the dividend that I'm going to receive?
Absolutely.
For owning the equity.
That's right. That's a great point and a good way to explain it. Okay, let's move to puts. Puts are, you got to think a little bit upside down, I guess, for extrinsic value. Now it's the option price minus the quantity. You got to do this quantity first. The strike price minus the stock price. Because if the stock is lower than the strike for a put, it makes it in the money. Okay, so we got to figure out how much that's in the money. That's the part in parentheses. Okay, again, let's go back to our fake example. Let's say their strike minus stock is $5. That's the parity or intrinsic value of the put. The option value is 7. As an example, 7 minus the 5 is 2. 2 becomes the extrinsic value or the premium that is going to decay to nothingness on either an exercise or that expiration. Yes, Jason, why are we laughing?
How do I get fireworks behind me?
Oh, did I do that? I can't see it.
All of a sudden there are fireworks all behind you. I was like,
I love it. I love it.
Extrinsic value exploding everywhere.
Everywhere. Okay, now Theta can be either terrifying or why is Theta terrifying? Well, I'm terrified of it. I know that. If you guys don't have an answer, I'm going to give you one. So, what's the terrifying part of Theta for people? Anyone? Bueller?
I mean, for me, it's especially when you're getting close to expiration, and you have like some out of the money option, or it's close. It's close to the money, but not quite out of the money. It's like a 20 delta kind of thing. It's terrifying because whatever thesis you had to get the price up to there, you're like, come on, work. That what was that old adage? The market can remain irrational longer than you can remain solvent. Yep. That really bites when you're talking about Theta. So I mean, yes, it's especially when you're long gamma, it could be quite terrifying.
Okay, good. I'm glad you said long gamma. Mark, you want to add anything?
I'll take the short side of it and say that it can also be terrifying on the short side when you're like, why won't this dude like decay? I'm only collecting these pennies for this thing. Like, just go, come on, time, move.
Right. Yeah, exactly. I've seen it. That's a good point. Cause I was, I made this slide. I was thinking more of the long side of premium or long gamma, long volatility, long stuff, and options are just decaying. You've got no movement on a Friday. You got a long weekend coming up, and you're like, oh my God, I'm going to get killed over this. And it's melting like a gosh darn ice cube. That was always terrifying to me. I just hated it. I hated weekends when I was long premium. But, what are you going to do, right? You got to scalp the heck out of your movement, out of your gamma to kind of make up for it, right?
But yeah, the weekends I trust those market makers that it's okay over the weekend. That's already priced in.
Yeah, that's true. Were you going to say something, Mark?
I was going to say, but the short wakes up Friday morning and is like, come on, this is a nothing burger. Futures aren't doing anything. Come on, go away, let's go.
Exactly, which leads us to Theta can be delightful. So this was kind of how I lived with Theta. I was the guy drinking the little, whatever that is, the umbrella drink, because I was typically short premium, collecting Theta, positive Theta. And by the way, for the folks, Theta is a negative number. If you are short a negative number, that means you're positive Theta collecting it. Okay. So that's true for calls and puts. It decays. So, on the short side of premium, it can be delightful. But Mark, tell us how it can be not so delightful, because the opposite is true from what you just said about long being, paying Theta.
Correct. And I'll take one of Jason's points earlier too, is that like, you're also short a lot of Vega here too, right? That like you were saying that an important component of like that extrinsic value is like the implied volatility component. Like if you are collecting Theta, you also have like some short option risk, and options implied volatility can go up. So like, implicitly, like there's the Vega element to it. I think, that's probably the most, when things go wrong, when storm clouds come to the beach.
Right. Yeah, and don't forget, when you're collecting Theta, you're most likely short gamma. Doesn't always have to be. There's a little tricks that you can avoid it, or at least get flat it. But you're probably short gamma typically. And if you're short gamma, what hurts you? Movement. So if you have really volatile markets, I don't care what your delightful time decay is in this scenario where you're short collecting Theta, you're probably going to get hit a little bit with a big volatile move, especially one that goes way up, way down in the same day, and you're negative scalping yourself to death, right?
Yeah.
So
I'll go with my my long gamma. Theta can be delightful.
Okay.
My favorite Theta move is a calendar, right? Like a long calendar where the back option is after an event and the front option is before an event. So like, let's say you have
earnings.
Yeah, earnings. Like let's say earnings is after market close.
Yep.
Yesterday was Tesla. I don't know what's today's earnings, like Apple or something.
Right.
I don't remember, but like let's say yesterday you're trading Tesla, and Tesla announces after the bell. You may have like a thesis or whatever, but a week in advance, you already know when Tesla is going to be reporting. You sell the option yesterday and you buy the option today, and with that event, that theta decays a lot quicker because the implied volatility keeps the price of the option high on your back end, and it increases your and the theta decays your front end. So you end up with a very, very wide P&L chart. And then, you know, at around like 350 yesterday, you close it before earnings come out, and you collect that. It's almost like free theta. It's really nice.
I don't close it. I let it go. I let the earnings go. I want to see the front month. I want to see implied volatility realign, and you know, I'm selling such a high volatility. But you know what always happens there, right, Mark? I always miss the move. It's always bigger than I expect.
Or it's exactly where it expects.
What's that?
Straddles have been so well priced over earnings over the last couple
yeah, I believe that. So I didn't check the Tesla straddle out, but we should talk about that next time to look what that move was being predicted as. So we'll do that on another one. So okay, what affects theta? Okay, obviously we've talked about time to expiration. Okay, and one of the things that Jason brought up earlier was implied volatility. So let's go over that real quick, and then we're going to shut her down here. We'll go through these 3 and 4 too real quickly too. What about implied volatility? What happens when implied volatility escalates, goes higher? What does that do to the price of options? Jason?
If implied volatility is going up, then the price of your option is also going up. Okay. The premiums are going up.
That's right.
Yeah. Extrinsic value.
Yes, the part over parity or intrinsic value, the part over that is where implied volatility has its effect. Okay, so think about it. If a vol is, you know, it's $2 over at, I'm making the numbers up again, 30 vol, and it goes to 50 vol, and it becomes $4 over, you know, again, making that up, that implied volatility increase has caused that premium to go up that much. Okay, so implied volatility has a big effect on theta. The bigger the premium, the more of that premium that has to decay down to zero as time goes on, right? Mark, anything to add there?
Yeah, that's what I was just going to say. I love using the extrinsic premium over parity number, the EPOP number, because if you're tracking that, you go, okay, so I'm short some structure. I'm short a condor, I'm short a call spread, I'm short whatever. Like, if has this actually like gone in the money? Like, is one of my legs through? Or is that why I'm losing money? Like, am I losing money on that delta or whatever on that move? Or is this just moving within my range and vol's gone up? And so like, I just now have more premium over parity.
Right.
I think is a really useful benchmark to understand or help dissect that theta versus vol component.
Right. Okay. Now the next two, interest rates and dividends, are a little tricky. Okay. And I think let's just talk about it, and let's tee it up next time to finish, because I know we're running long here. But interest rates are interesting. So when interest rates rise, right, it increases call extrinsic value and it decreases put extrinsic value. Okay. Anyone want to give a crack at why real quick, and we'll break it down next time. Any thoughts?
Go ahead, Mark. I got extra comments.
Okay. Mark, do you know this one?
I think we should punt this to next time, because I want to talk to you and confirm I understand. I know what you're saying here.
Okay. Let's punt it next time, and I'll give a quick explanation of it that no one's going to understand, because it has to do with conversions and reversals. But let's go to dividends real quick. Opposite happens. So if what happens with dividends, as you increase dividends, it reduces the extrinsic value of calls, increases the extrinsic value of puts. Okay, my quick explanation on both of these is, think about this. When I first got in the business, one of the things my mentor taught me about this is I had already learned conversions and reversals. So a reversal is buying a call, selling a put, same strike. That's synthetic long stock, selling stock against it. So in that complex, if interest rates go up, all things are good for that complex. You're getting more short stock interest on your stock that you're short. And that being said, you'd rather have that scenario on because it helps calls and it makes puts go down. You're long a call, that's good. You're short a put, goes down, that's good, because that whole complex has to be back to some sort of parity. All right, we'll break that down later. Don't worry about understanding that yet. Conversely, with the dividends, same deal. I'd rather have a conversion on the opposite of what I just said, because I want to own the stock when dividends go up, because it gives me more money. Therefore, the complex, the put's going to go higher in that scenario. The call is going to go lower. It makes that conversion more pretty and yummy to eat. Did I just say that?
Yummy conversions.
Yummy conversions. So
Yeah, one thing you missed there, Lex. The delta of the option does have an impact on theta. Like your theta is greater at the money than it is out in the wings.
100%.
In a static way.
Yep.
And
what's the biggest theta option delta wise?
Yeah, it's 50.
Okay,
right in the middle.
Right. Why is that? Because it's the at the money option. It's got the most amount of premium because that at the money option is going to have more premium than the 40 delta option because that's out of the money 100%. The 30 delta and so on. It's going to kind of go down on the scale of price as it goes. The calls go farther out of the money. Right. Makes sense. Same with puts. You have that 50 delta option as being the crux of theta juice, as it were. Right. Good point.
However, I do want to also point out that something also to pay attention to is the farther out you are, though, on deltas, the lower, I guess, is your theta. No, the higher is your theta to Vega ratio. Where,
gosh darn, you love this. You got a Vega tattooed on your rear end.
I'm sorry, man. Vega is what we are. We're Vega traders, man.
Jeez, Pete, you and this Vega. You got they have new. The Vega man has new pictures of you somewhere.
The Vega man. That sounds like some cryptid out of south side of Chicago.
Yeah, I'm gonna have my son make a meme for that one. But yeah. So the theta decay on last time we spoke, or no, I guess we didn't speak about it yet because we're speaking about Vega next week. But it's where it takes a while to get to intrinsic value. Like if it takes a large move to get any intrinsic value, your theta is going to have more impact than any kind of Vega change or even gamma change. So when you're way out there in the money or way out of the money, that theta has a larger impact than the other Greeks, although statically less impact than it would at the money.
Okay, good point. I love it. All right, guys, we got to run. We went way over. Sorry, I thought theta was going to be like a 15-minute. This is a freaking marathon. But good points all the way around. Any closing thoughts, Mark? Because we're going to go.
Nope.
Oh my God. Okay. Well,
happy trading.
Happy trading. You guys have a great weekend, and I will talk to you next week on Vega, and we'll kind of pick up some of this other stuff. All right. On dividends and interest rates.
I want to talk to you about that.
Okay. Ding.
All opinions expressed by Trader Hub contributors are solely the contributors' opinions and do not reflect the opinions of Trader nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Trader nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.